Welcome to the research desk.
We want you to picture the trading floor of a major institutional bank at 2:45 p.m. on May 6, 2010.
Right. The environment there is normally defined by a low, constant hum of calculated risk. But within a span of just 5 minutes, that hum turns into absolute silence and then sheer panic.
Blue-chip American corporations, companies with massive physical footprints, millions of employees, and billions in real revenue, are suddenly trading for a single penny on the screens.
$1 trillion of market capitalization just evaporates into thin air, seemingly without a single fundamental cause, only to reappear moments later. And that is the reality of the market ecology we live in today.
Over the last 75 years, quantitative finance shifted from this niche analytical tool confined to academic journals into the literal operating system of modern markets.
Which forces us to ask a question that gets to the very core of how capital flows today. Did machines actually defeat human investors, or did they simply force everyone to play a faster, harsher, and far more fragile version of the exact same game?
The prevailing assumption across the entire financial industry is that better average functioning somehow equates to better system resilience.
People believe that because we removed human emotion from the execution of trades, we have somehow removed human panic from the market itself.
I want to stress test that assumption by looking at the empirical evidence, because better average efficiency does not mean better tail risk resilience.
You are arguing that quantitative models have fundamentally compromised the market ecology.
I am. They have not eliminated risk. They have manufactured entirely new types of systemic risk. We basically replaced the localized, idiosyncratic failures of individual human investors with massive, correlated structural failures that threaten the entire foundation of the system.
Well, I champion the counter perspective on this. The quantitative revolution successfully transformed investing from an artisanal craft into a highly efficient, industrialized factory system.
An industrial factory system that occasionally explodes?
But a vastly superior one overall. It took the uneven, highly emotional, and frankly unscalable process of human judgment and replaced it with rigorous, repeatable discipline.
So we need to examine the actual mechanics of this transformation, right?
Yes. We will trace the triumph of Renaissance Technologies, a firm that proved empirically that markets contain thousands of machine-detectable inefficiencies.
And we will also examine the devastation of long-term capital management and the terrifying mechanics of the flash crash.
Through all of these events, we will reveal why the most dangerous element in the market isn't artificial intelligence or algorithmic code. The most dangerous element is human overconfidence wrapped in complex mathematics.
We really must ground this discussion in the sheer scale of the shift before we dissect the specific mechanisms. In the 1980s, algorithmic trading accounted for less than 10% of United States equity volume.
It was a total anomaly, a rounding error in a market that was still dominated by humans literally yelling on trading floors.
But by 2015, that figure had risen to over 50%. Today, it completely dominates the landscape. The market is no longer merely influenced by code. Code is the environment.
Code determines the weather, essentially. This shift fundamentally altered market microstructure.
Markets became faster, far more fragmented, heavily automated, and deeply reflexive. Execution itself became a primary source of alpha. It stopped being just the final administrative step of an investment thesis.
To truly understand the magnitude of that shift, consider the era of Benjamin Graham. His approach to security analysis was the absolute definition of an artisanal craft.
It was incredibly manual. It required an individual to physically acquire corporate balance sheets and, read through dense Moody's manuals page by page.
Exactly. You had to calculate net current asset values by hand and make a highly subjective judgment about the margin of safety for one specific company at a time.
It was brilliant logic, obviously, but it was incredibly slow. It was entirely dependent on the specific cognitive bandwidth and the physical stamina of the individual analyst. Right. And quantitative finance did not invent new financial logic. It simply codified Graham's logic and scaled it to a level of industrial production. Let us pause and unpack what you actually mean by codification. Because it is very easy to throw around terms like factor models without explaining the underlying mechanism. Fair enough. A traditional value investor looks at a company, sees a low price-to-earnings ratio, reads the management guidance, and decides the stock is cheap. That is a subjective, human judgment. It relies on narrative, yes. And a quantitative factor model takes the concept of value, that underlying idea that cheap stocks outperform expensive ones, and turns it into a strict mathematical parameter.
So it scans 10,000 global equities simultaneously.
Exactly. It scores every single one of them based on their price-to-book ratio, their cash flow generation, and their debt load. And then it automatically builds a portfolio of the cheapest quintile while shorting the most expensive quintile.
The underlying objective remains exactly the same as Graham's. You want to identify mispricing and exploit it.
But the machine completely strips away the narrative bias. It does not care if the chief executive officer sounds charismatic on a financial television network. It executes the logic flawlessly at massive scale.
Which brings a dangerous illusion of safety, if you ask me. You were describing the triumph of behavioral discipline, and I agree, human investors are hopelessly vulnerable to cognitive biases.
We anchor to past prices. We suffer from extreme overconfidence. We herd with the consensus constantly.
A mathematical model does not panic. I grant you that. But stripping away emotion also strips away intuition. It removes the human ability to recognize when the context of the data has fundamentally changed.
Well, the numbers heavily favor the machine's lack of emotion. Beyond behavioral discipline and codification, the quantitative approach completely mastered execution and data expansion.
Data expansion is a massive part of this, yes.
A discretionary human investor might spend 3 weeks identifying a brilliant mispricing in a mid-cap manufacturing stock. But by the time they actually build the position, their buying activity moves the price, eating into their own potential profit.
Slippage.
Right, slippage. A machine implements thousands of trades with exponentially lower slippage, adapting to changing order book dynamics in microseconds.
And it does this using an informational field that human analysts cannot physically comprehend.
We are talking about algorithms ingesting real-time satellite imagery of retail parking lots. They use that to predict quarterly earnings based on car counts before the earnings are even officially announced.
Or aggregating anonymized credit card transaction flows. They track consumer spending down to the specific zip code on a daily basis.
You are building toward the ultimate expression of this bull case. We are talking about the industrialization of alpha, which inevitably leads us to the story of Renaissance technologies.
No firm better encapsulates the triumph of the machine over the artisan than Renaissance.
Jim Simons, a former codebreaker and a brilliant mathematician, founded Renaissance Technologies in 1982. And he did not hire Wall Street veterans.
He hired physicists, astronomers, and statisticians. He built a research culture entirely around mathematics, signal extraction, and relentless empirical testing.
The results almost defy the foundational theories of efficient markets. Their flagship medallion fund generated annualized returns exceeding 39% net of their exorbitant fees from 1988 to 2018.
And before fees, their long-run performance is estimated at an astonishing 66% annualized. That is practically science fiction in the finance world.
But we must look at how they actually generated those returns. It was not by predicting macroeconomic shifts or, forecasting interest rates like macro hedge funds do.
It was the relentless harvesting of tiny, fleeting inefficiencies.
Renaissance proved that markets contain thousands upon thousands of small, machine-detectable anomalies. Anomalies that are completely invisible to traditional stock pickers.
They deployed statistical arbitrage. So if a complex historical pattern indicated that when a specific basket of French telecommunications stocks rose, a specific basket of German utility stocks would briefly fall 3 seconds later, they exploited it.
They built a system to exploit that relationship millions of times over. They did not need a better narrative about the geopolitical landscape in Europe.
They just needed vastly superior pattern recognition and absolute secrecy.
And the techniques pioneered by firms like Renaissance eventually bled into the mainstream. They democratized investment management by bringing systematic risk models and factor-based exchange-traded funds to ordinary retail portfolios.
You argue that the quant revolution professionalized the financial infrastructure.
It absolutely did.
Well, I hear the statistics regarding Renaissance technologies. I acknowledge the 39% net returns and the massive expansion from 10% to 50% algorithmic volume.
But you have a fundamental challenge to the premise.
I pose a structural challenge to the core premise of the bull case. If these systematic models are so perfectly disciplined, so devoid of human emotion, and so computationally superior, why do they keep blowing up the global financial system?
You are looking at the tail risk events again.
Because every major quantitative breakthrough in the history of finance has simultaneously revealed a catastrophic structural limit.
You are arguing that the models inherently create systemic blind spots?
I am arguing that the models constantly mistake the map for the territory. Look at the progression of financial engineering over the decades.
Start with the capital asset pricing model.
Exactly. The capital asset pricing model offered this very elegant way to quantify and simplify risk through the concept of beta, measuring how a stock moves relative to the broader market.
It is foundational to modern portfolio theory.
But it completely missed the reality of fat-tail distribution events, the sudden violent market gaps that wipe out entire portfolios in hours.
And then came the Black-Scholes model.
Right. Black-Scholes revolutionized the pricing of options, making risk tradable on a massive global scale. But the mathematics assumed continuous market liquidity and constant volatility.
It assumed away the very instability that matters most during a genuine crisis.
Statistical arbitrage industrialized the harvesting of small edges, but in doing so, it made market crowding and endogenous correlation far more dangerous.
So you're saying models fail structurally, and they fail at the edges.
They fail spectacularly when leverage, liquidity mismatches, and algorithmic imitation collide in the real world.
This brings us to the concept of false precision.
It is the cornerstone of the $4.6 billion warning that the industry largely just ignored.
Quantitative models produce outputs that carry an overwhelming aura of scientific authority.
We look at Sharpe ratios, value at risk estimates, and implied volatility metrics, and because these numbers are generated by supercomputers and complex calculus, we treat them as ironclad laws of physics.
But a value-at-risk model simply calculates the maximum expected loss over a specific time frame based entirely on historical price movements.
These outputs depend on extremely fragile assumptions. They assume correlations between asset classes will remain stable under stress.
They assume you will always be able to exit a position because continuous liquidity will always magically exist.
The cleaner the mathematical model, the easier it is for highly intelligent people to forget that reality is infinitely messier than the math.
The collapse of long-term capital management in September of 1998 is the ultimate historical anchor for this argument.
It really is the defining cautionary tale of the quantitative age. We need to break down the mechanics of long-term capital management because the failure was entirely rooted in this false precision.
The fund was founded by John Meriwether, a legendary bond trader from Salomon Brothers.
And it was advised by Myron Scholes and Robert Merton. These men literally won the Nobel Memorial Prize in Economic Sciences for their work on derivatives pricing while they were at the fund.
This was arguably the most intellectually formidable assembly of financial talent in modern history.
And they built enormous, highly leveraged convergence trades.
We need to clearly explain what a convergence trade actually is, mechanically, so the sheer magnitude of the failure makes sense to the listener.
Imagine two bonds that are nearly identical in their fundamental risk. For example, a 30-year United States Treasury bond issued today. This is known as an on-the-run bond.
And compare that to a 30-year Treasury bond issued 3 months ago, which is known as an off-the-run bond.
Because investors prefer the shiny new bond, it trades at a slightly higher price. The older bond trades at a slight discount.
But the fundamental credit risk of the United States government is identical for both assets.
Exactly. The mathematical models at LTCM dictated that the price difference between these two identical assets had to eventually converge. The spread mathematically had to close.
So LTCM would buy the cheaper off-the-run bond and short sell the expensive on-the-run bond.
But the price difference between those bonds is microscopic. It is measured in mere fractions of a percentage point.
Which is why they used massive, unprecedented leverage.
They often borrowed $25 or more for every single dollar of equity they held. They had to amplify those tiny spreads into massive hedge fund-sized returns.
And the math dictated that the spreads had to converge. It was considered a literal statistical certainty by the Nobel laureates running the fund.
Their value-at-risk model showed the probability of a catastrophic loss was virtually zero.
Right up until August 1998. when the real world introduced a variable the models deemed statistically impossible.
Russia defaulted on its sovereign debt.
This triggered a massive global flight to quality and liquidity. Institutional investors everywhere just panicked.
They rushed into the safest, most liquid assets available, the newly issued on-the-run treasuries. And they completely abandoned anything with even a hint of illiquidity, including the older, off-the-run treasuries.
So instead of the spreads narrowing as the Nobel-winning models predicted, the spreads widened violently.
The historical correlations broke down entirely. LTCM was suddenly facing catastrophic margin calls on positions that their complex risk model stated could not possibly lose that much money in a single lifetime.
The sheer scale of the leverage turned a mathematical miscalculation into a legitimate systemic threat.
The fund hemorrhaged roughly $4.6 billion in a matter of weeks.
The size of their leveraged position spread across derivatives contracts with almost every major bank on Wall Street meant their collapse threatened to take down the entire global financial system.
The Federal Reserve literally had to step in and coordinate a massive private bailout by 14 major banks just to prevent total systemic contagion.
The models were brilliant. They dominated normal, functioning markets perfectly.
But they broke fundamentally and disastrously when reality stopped being normal. The math became a highly dangerous false map that led the smartest men in the room directly off a cliff.
I have to challenge that framing, though. Attributing the failure of LTCM strictly to the machine or the mathematics completely misses the human element at the absolute core of the disaster.
How so? The models dictated the trades.
Long-term capital management was fundamentally a failure of human hubris. The mathematical relationship between those bonds was technically correct over a long enough time horizon. They do eventually converge.
But markets can remain irrational longer than you can remain solvent.
Precisely. The failure was that the models did not force John Merriweather to lever the fund 25-1. Humans made the discretionary, greedy decision to apply astronomical leverage.
The leverage was required by the strategy, though. You cannot generate 30% hedge fund returns on fractional basis point spreads without massive leverage. The math necessitated the fragility.
Even so, humans built the convergence trades, and humans decided to ignore the qualitative risk of an emerging market sovereign default. The architects lacked the behavioral discipline to survive a tail risk event.
I find it hard to separate the human hubris from the mathematical arrogance. They fed into each other.
But the broader market genuinely learned from the failure of 1998. The industry did not abandon quantitative finance after LTCM. It vastly improved it.
I would argue it just mutated it.
Risk models became significantly more sophisticated. Stress testing for extreme tail events, like running scenarios where historical correlations break down to 1, became an absolute industry standard.
Sure, they patched the 1998 bug.
The legacy of that era is the creation of systematic portfolio tools that actually survive stress. The system adapted and grew much more resilient over time.
I disagree entirely. What the market actually built set the stage for a new, far more terrifying type of catastrophe. We moved from exogenous risk to endogenous instability.
Endogenous meaning generated from within?
Exactly. Historical market shocks almost always originated from outside the financial system. A geopolitical war breaks out, a massive crop failure occurs, a central bank makes a drastic policy error, or a severe recession hits the real economy.
Those are the classic exogenous shocks. The market acts as a passive mechanism that prices in that external reality.
But in the machine era, in a market where algorithmic trading dictates over 50% of the volume, the most violent shocks come from inside the system itself.
You are saying the market has become a machine that physically manufactures its own risk.
I am. I can trace this endogenous instability through 3 distinct structural failures that prove efficiency has mutated into sheer fragility. We begin with Black Monday.
October 19th, 1987.
The Dow Jones Industrial Average fell a staggering 22.6% in a single trading session. Think about the magnitude of that destruction.
A quarter of the value of the American industrial economy was just erased in a matter of hours.
And the proximate cause was not a sudden war or a profound shift in corporate earnings. The cause was portfolio insurance.
Let us detail how portfolio insurance actually functioned, because it was an early form of programmatic trading.
It was an automated hedging strategy designed by academics. The logic was theoretically simple. As the stock market declines, the computer program automatically sells index futures to protect the portfolio against further losses.
It effectively replicates a put option dynamically.
But when multiple large institutional funds used the exact same programmatic strategy, a fatal feedback loop emerged. Initial selling in the morning triggered a price drop.
The computer models detected the drop and automatically executed sell orders in the futures market.
And this massive wave of futures selling drove the broader market lower, which triggered the next downward threshold in the computer models, unleashing another wave of automated selling.
It created a relentless mechanical downward spiral.
It proved definitively that elegant risk models are entirely useless when markets gap violently due to their own internal mechanics.
Portfolio insurance was a primitive mechanism, though. It was a blunt instrument compared to modern statistical arbitrage.
Which makes the second failure vastly more concerning, because it involved the most sophisticated models on Earth. Fast forward to the Quant Quake of August 2007.
This was a moment when highly sophisticated statistical arbitrage funds suddenly dropped 20% or more in a matter of days.
Funds that had posted years of incredibly smooth, market-neutral returns. And again, there was no massive geopolitical shock that week. The cause was a crowded unwind.
The models were all finding the exact same signals?
Multiple brilliant quantitative funds operating in complete secrecy had independently discovered the same subtle pricing inefficiencies. They built similar mathematical models to exploit them.
The strategy was immensely crowded, but nobody knew it because the positions were opaque.
When one major multi-strategy fund faced severe liquidity pressures in its subprime mortgage portfolio, it had to raise cash immediately. To raise cash, it began to systematically liquidate its highly liquid statistical arbitrage portfolio.
As they aggressively sold their long positions and bought back their short positions, they pushed the prices of those specific securities violently in the wrong direction.
Which hit the balance sheets of every other quant fund running the exact same strategy.
Every other fund suddenly saw their portfolios bleeding capital rapidly.
Their automated risk models, seeing the sudden losses and spiked volatility, triggered automatic stop losses, forcing them to also liquidate the exact same positions.
This triggered further price movements, margin calls, and forced selling across the entire quantitative ecosystem.
The models were all correct in the exact same way, right up until the moment they were mathematically forced to be wrong together. It was a complete failure of market ecology. It exposed the extreme danger of algorithmic crowding.
And the flash crash of 2010 accelerates this entire dynamic from days down to milliseconds.
May 6, 2010. The Dow plunges nearly 1,000 points in minutes, completely untethered from any fundamental economic reality.
Only to recover the vast majority of those losses shortly afterward.
This exposed the terrifying reality of liquidity illusion. High-frequency trading systems and algorithmic market makers provide incredibly abundant liquidity when the waters are calm.
They compress the bid-ask spread to fractions of a penny.
But their algorithms are hard-coded to manage risk by stepping away during severe, unpredictable volatility.
The moment genuine stress enters the system, in this case, triggered by a massive automated sell order of E-mini S&P 500 futures, these machines detect the anomaly.
And they withdraw their liquidity in milliseconds. The liquidity evaporates precisely when human investors need it the most. It creates a total vacuum where prices enter free fall.
This is a profound structural failure of the automated market ecology.
A company's intrinsic value does not drop by 99% for 3 minutes. The plumbing of the market simply broke.
I reject the framing that these events prove systemic brokenness, though. You are taking terrifying anomalies, Black Monday, the Quant Quake, the flash crash, and presenting them as the defining characteristics of modern finance.
They define the tail risk.
We must weigh these tail risk events against the reality of everyday market functioning. Despite the flash crash, everyday bid-ask spreads are tighter than they have ever been in financial history.
I do not dispute that execution costs are lower.
The cost of executing a trade for a retail investor has plummeted effectively to zero. The efficiency of capital allocation on a global scale is unprecedented.
But at what hidden cost to stability?
Can we really dismiss the massive, compounding daily savings for tens of millions of normal investors, just because the complex automated system occasionally sneezes?
A sneeze?
We are looking at a system that processes billions of data points flawlessly for years on end. You are focusing entirely on the microseconds where the safety valves trigger an automatic shutdown to prevent worse damage.
A system that occasionally sneezes does not erase a quarter of the Dow Jones in a single afternoon. The safety valves did not prevent damage in 1987 or 2010. The automated logic was the source of the damage.
I hear you. To reconcile the tension between this remarkable everyday efficiency and the terrifying tail risk fragility, we have to stop thinking of quantitative finance as a tool that simply replaced human actors.
We have to understand how it fundamentally altered the environment those actors operate within.
To visualize that environment, we must conceptualize quantitative finance as a river current. A current that massively accelerates the flow of water without redrawing the fundamental terrain of the valley.
I think the river analogy is the perfect way to look at this.
Imagine a river that has flowed through the same geographic valley for centuries. Suddenly, the current is accelerated to machine speed. Because the water is moving exponentially faster, the banks erode much sharper.
The eddies and whirlpools become vastly more violent.
Small disturbances upstream travel much farther and hit with much greater kinetic impact.
But the valley itself, the underlying bedrock of financial gravity, remains exactly the same.
The terrain of fundamental valuation, the constraints of leverage, the physics of liquidity, and the enduring reality of human fear still dictate exactly where that river can ultimately flow. Dramatically increase the speed of price discovery. It magnified the force of crowding, and it amplified the violence of feedback loops. But it did not repeal the laws of financial gravity.
It certainly did not eliminate the leverage cycle.
It did not cure the human instinct to herd, nor did it make panic disappear. It simply made panic faster, more synchronized, and mechanically relentless.
That analogy perfectly captures why old market behaviors persist, even as the system becomes hyper-interconnected. The river moves faster, but the water still crashes into the exact same rocks.
Which leads directly to the speculation surrounding the future of this ecosystem. We have to address the role of artificial intelligence and machine learning.
And the rather dangerous belief that more compute power will somehow solve the fragility problem.
The bull case for artificial intelligence in finance is supported heavily by research. Rassahoff and Jones in 2019, for example, suggest we are on the precipice of another structural leap that could actually stabilize the system.
Stabilize it how?
They argue that machine learning might finally allow models to outsmart the deeply ingrained behavioral limits of human programmers. Traditional quant models, even the most sophisticated statistical arbitrage engines, are still bounded by the hypotheses of their creators.
Right. A human still has to tell the machine what factors to look for.
Exactly. But AI, utilizing deep neural networks, processes vast, unstructured datasets to uncover entirely new, non-linear signals. It finds complex relationships that humans cannot even conceptualize.
I am highly skeptical of this solving the actual problem.
If AI can dynamically adapt to regime changes and real-time learning as the market shifts, it could theoretically solve the problem of false precision that plagued long-term capital management.
You think it will predict the liquidity vacuum before it forms?
It could create a system that doesn't just execute efficiently in normal times, but proactively manages risk during abnormal stress by recognizing the pattern of a crash early.
I view the prospect that artificial intelligence will miraculously solve market fragility with genuine incredulity. The assertion that AI escapes the core traps of quantitative finance ignores the fundamental, reflexive nature of the market ecosystem.
You believe AI falls into the same trap as statistical arbitrage?
AI does not escape the trap. It deepens it. I look at the work of Arnott and Harvey from 2018. They explicitly warn about the massive, pervasive danger of overfitting in machine learning models applied to financial markets.
Overfitting meaning it finds patterns that are not really there.
A deep neural network is incredibly powerful at finding patterns in historical data. It will find a signal. But in finance, the danger is not just that a model is too simple, it is that a model is too clever for a world that refuses to sit still.
Financial data is extremely noisy compared to physics or, image recognition.
Precisely. and AI will find patterns that worked perfectly over the last 10 years but are entirely spurious. They are driven by pure mathematical coincidence rather than underlying economic reality.
The machine learns from the past, but the future simply does not look like the past.
The AI operates in a system that physically changes in response to its own learning. If an AI discovers a brilliant new signal and deploys massive capital to exploit it, that very act alters the market microstructure.
The footprint of that strategy is left in the order book for everyone else to see.
Other sophisticated actors and other competing AIs detect that footprint and imitate it. The trade becomes crowded instantaneously. The alpha is arbitraged away almost immediately.
AI does not create permanent alpha. It merely accelerates the decay of alpha.
It shortens the half-life of any discovered edge. The cycle of discovery, crowding, and inevitable decay spins faster and faster.
So better machine learning does not fundamentally change the game.
It does not change the fact that a model can be individually sound in a backtest, yet becomes systemically dangerous in reality once too many balance sheets are leaning on the exact same pattern at the exact same time.
The AI illusion is the belief that superior compute power can solve the ecological problem of crowding.
It mathematically cannot. The river is just moving faster.
As we examine the limitations of AI and the enduring gravity of the financial river valley, we are arriving at a shared verdict regarding the future of the investor.
We have traversed a massive shift. From the artisanal days of Benjamin Graham calculating asset values by hand, to the algorithmic dominance of Renaissance technologies, generating 39% net returns for statistical arbitrage.
We have walked through the hubristic collapse of long-term capital management, losing $4.6 billion, and into the mechanically induced terrors of the Quake and the flash crash.
And we see clearly that the extreme positions are both untenable today.
Pure discretionary investing is simply too slow, too biased, and too unscalable to survive at machine speed. A human stock picker cannot process satellite imagery and anonymized credit card flows fast enough to compete with a quantitative fund.
But pure quantitative investing, left completely autonomous, is far too blind to survive profound regime shifts,
Unpredictable geopolitical shocks, and the reflexive dangers of crowded unwinds.
Pure Lath cannot understand the qualitative nuance of a sudden sovereign default or a massive regulatory overhaul.
The durable edge in modern finance belongs strictly to hybrid systems. It belongs to institutions and individuals who successfully integrate systematic machine speed execution with qualitative human judgment.
The true competitive advantage is no longer about having the fastest model or the most complex neural network. It is about possessing the wisdom to know precisely when not to trust your models.
It is the ability to recognize when the world has changed so fundamentally that historical data no longer means what it used to mean.
Like when the macroeconomic regime has shifted from low inflation to high inflation, or the geopolitical landscape has fractured. The models are highly detailed maps, and the hybrid investor knows exactly when to look up from the map and recognize that the actual territory is on fire.
The historical record absolutely validates this synthesis. The quantitative revolution fundamentally transformed market microstructure.
It compressed time horizons and turned execution into a primary strategy.
It made alpha more statistical and vastly more scalable. But it did not repeal valuation. It did not abolish liquidity constraints. It did not neutralize geopolitics.
The quant revolution did not replace human markets.
It forced human markets to move at machine speed.
If modern alpha is increasingly just a vertically integrated supply chain of data acquisition, cloud compute, and low-latency execution, what happens to the market ecology when the next major, unprecedented macroeconomic shock hits a system where over 50% of the volume is entirely automated and everyone's machine learned from the exact same historical data? This is the research desk officially signing off.